Welcome to our in-depth video on behavioral finance for experienced stock market investors. In this video, we will be delving into the intricacies of behavioral finance and how it can impact investment decisions. We will be discussing common biases that investors face and the strategies that can be used to overcome these biases. One of the most prevalent biases that investors encounter is overconfidence. Many investors overestimate their ability to predict future stock market movements. This can lead to poorly informed decisions. You can never predict the future. This overconfidence can result in taking on too much risk or holding on to losing stocks for too long. In order to avoid this bias, it's essential to keep a trading journal to track the reason and emotion behind each trade. This journal will help investors to be more aware of their own biases and make better informed decisions. Another common bias that investors encounter is anchoring. Investors tend to rely too heavily on the first piece of information they receive, which can bias their subsequent decisions. To avoid this bias, it's crucial to seek out multiple sources of information and perspectives. This will help to provide a more balanced view and reduce the chances of making a decision based on a single piece of information. Herding is another bias that investors need to be aware of. Investors tend to follow the crowd even when it's not the best decision. To overcome this bias, it's important to have a well-diversified portfolio. Diversification can help to reduce the impact of herd mentality and increase the chances of making a profitable investment decision. Lastly, loss aversion is a bias where people tend to feel the pain of losses more than the pleasure of gains. This can lead investors to sell winning stocks too early or hold on to losing stocks for too long. To avoid this bias, it's important to use stop-loss orders to limit losses. Stop-loss orders can help to automatically sell a stock when it reaches a certain price, which can help to minimize the impact of loss aversion. In conclusion, understanding and addressing behavioral biases in investing is crucial for experienced investors. By implementing techniques such as keeping a trading journal, seeking out multiple sources of information, having a well-diversified portfolio, and using stop-loss orders, investors can make more rational and profitable investment decisions. We hope that this video has provided valuable insights and strategies for overcoming behavioral biases in investing. Thank you for watching.